and welcome everybody to the latest in NCP's series of educational podcasts or videocasts. Joining me today are my associates, Ovi Shiopo and Sam Colby. And joining us from Cayman today is Rod Gordillo, who is president and one of the principals of Resolve Asset Management. Before we start, just a quick disclaimer that these presentations are for education purposes only. This is not investment advice. Please speak to your own advisor if you hear something that's of interest to make sure that it's appropriate to you. But I think I'll start off. And Rod, can you just give us a quick background on yourself and what you're up to these days?
Sure. I am a president and portfolio manager at Resolve Asset Management, and I'm also the trading advisor for the return stacked ETFs, both in the U.S. and Canada. And what our focus has always been is on pushing out non-correlated systematic investment strategies that can benefit from movements in global equities, global bonds, global commodities, and global currencies. So I want to give myself as wide of an opportunity set as possible to be able to navigate the crazy global macro markets that we're in. I've been at it for about 20 years. I'm originally from Peru, probably the reason why I got into global macro and not into Warren Buffett style investing. In 1989, moved to Canada because of a 6-month hyperinflation period of 7,200% that left us basically a lot of zeros behind the bank account in Peruvian dollars, but in US dollars, what used to be $1 million ended up being basically zero, and forced us to emigrate to Canada, which was fantastic, and had a few ups and downs there with my father being highly concentrated in a lot of portfolios. And when I graduated, what I knew is I didn't want that. And so it kind of, my formative years informed the way I was going to think about investing. And I think global macro and in a systematic, discretionary way was the path forward for me. Oh, and I forgot, my dad was a math professor and a software developer. So of course, that's the other side of things.
The apple does not fall far from the tree, does it?
That's right.
Yeah. Today's sort of broad topic is I've titled it a changing world order. But so I think it actually your background in Peru and how things changed so quickly for you and your family and caused major financial harms as long as the rest of the stuff that goes along with it is really relevant to what's potentially could happen to the rest of us. And I guess the first question that I'd like to pose today is, are we in a paradigm shift, and is the world order really changing, or is this just a bump in the road, just another blip? We've had Trump in the presidency before, caused some angst and upset, but he left. We had 4 years of reasonably good markets, COVID notwithstanding, but now we're back at it.
I think it would be, it would be unfortunate to think that we're not going to go par for the course in this globalized economy, that we're not going to continue that way. We're probably not going to continue to the same extent. I think the connections are there, that it's going to be some semblance of the old world order, but we are certainly moving into a clear new paradigm shift that is a little bit of the opposite of globalization. You're going to have more strongmen, and I know about strongmen from Latin America and what it can do. I think the big difference here between a strongman in LATAM and a strongman in the largest economy in the world is that at this point, they can probably be very insular and be okay, and that's why they're moving towards that. But it'll be at the detriment of the rest of the world that still kind of needs the United States to continue to protect them and have world trade with them. But with their energy independence, with their wealth, and if they figure out manufacturing, that continued movement towards the U.S. being more isolated is going to have massive impacts to the global world order and global macro markets going forward. And we can talk a little bit about the repercussions of all of that. But certainly, things are changing, and And whatever we have intuited as to what the markets are going to do over the last 10 years, 10, 15 years, I think that intuition that we built up, the average investor has built up over that time frame, I don't believe that intuition is going to serve them well in the next decade.
And do you think this is really all about Trump, or you think there's other factors here too? And I'm thinking, and expand on this or take me in a different direction if you want. I'm thinking of Ray Dalio's thesis on a changing world order, which is where I purloined the title for this podcast from. Um, is this really all about Trump, or are there other things at play, and that we should be paying attention to, whether it's demographics, technology, the rise of empires, which is his rise and fall of empires, which is his overreaching thesis?
Yeah, I think there's a variety of things, and demographics is a big one, right? We have out of the major G7 countries, most of them are shrinking in terms of the workforce, and we're getting more and more people in the retirement age that is going to be it's going to go from contributing to the GDP to extracting as much as possible. And as you do that, you definitely create this feeling of, well, what are you going to do for me? And how are you going to keep me safe? How are you going to get the income for me? And those voters are the ones that are really going to define some of the policies that are going to affect us over the next decade or so. So demographics are absolutely key. I think you're dealing with a growth rate that's likely to be slower in the G7 countries at the same time that there's going to be inflation embedded as we try to decentralize or centralize the manufacturing sector in every country. You see Germany's doing that right now. There's a big push and there's going to be some fiscal spending that is going to be looking inward. And so all of these, it's not just Trump. This has been happening in Latin America with looking inward and trying to protect their own sovereignty and trying to de-emphasize global trade. But we're seeing it in the U.S. We're seeing it in the U.K. with the Brexit. So these are common themes that tend to happen in kind of 75-year cycles. And sadly, that tends to lead to periods of war as well, right? We've had the longest running period of peace, but we have seen a spike in proxy wars in the last 10 years where we're fighting, but we're not really fighting each other. And of course, that's going to lead to conflict that is going to make it more and more difficult to, invest in markets today. But it isn't, I think Trump is a result of all these global trends. He's not the cause of it. He may be the most powerful strongman, but he's certainly not the only one that has been elected in recent decades.
Yeah, I would certainly say that his genius, if you can call it that, is to have recognized that and been able to tap into it and energize it.
Well, he's been tapped into it since the 80s. He's been talking about tariffs and protecting the middle class and how the hollowing out of the middle class and how we're not going the U.S. needs to protect and compete. This is nothing new. Like, he's been having this rhetoric for decades. The difference is that the world has moved and the populations have suffered, the middle class especially in this globalized, financialized world, to the extent that all of a sudden the things he was saying in the 80s now deeply resonate with the middle class. And so I think, again, it's his time to manifest what he's been saying. They just found a man to represent him.
Yeah.
He wants to repatriate manufacturing into the U.S., which is understandable.
Yeah.
But I think one of the reasons why it went offshore was it was just so much cheaper to build things offshore, and it helped them lower inflation and get more goods. So how's this, this idea of tariffs and bringing things onshore going to impact the economy in the U.S.?
Well, I mean, we can talk about what the impact is going to be. Clearly, it's going to be a degrowth policy, right? It is in the short term, at the very least, it's going to cause the multiples to compress a little bit. We are seeing not just the tariff policies are clearly going to create frictions, and frictions create chaos in planning for each one of these companies. Like my brother was telling me yesterday that he was running a shipping company and everything was ready to go. And then they realized that if this Trump policy goes through, for every ship that goes through the Panama Canal, it's going to cost $1 million every time they go through. Now that ends any conversation, right? They don't know whether it's going to go or if it's not going to go. But these types of quick shifts in policy just literally halt most planning that businesses can do until the chips fall where they may. So certainly tariffs and the Doge policy of kind of you're going to lay a bunch of people off, and the hope is that they get re-added into the private sector and we're more efficient going forward. But in the short term, it is definitely going to be a negative growth shock. Right? But
Yeah.
we can talk about policies, and I can talk about what they think the policies are going to do and why they think it's useful. But the end reality is that it is these policies, and they're not even priced into the market yet. But the policies are certainly going to be negative growth shocks.
Yeah, but it's also going to affect different countries different ways. I mean, because we have a number of things at play here. Demographics, aging populations within not only within the G7. Obviously, Japan's been there for a long time, but even China now. The labor force is starting to shrink. Population is now starting to shrink, and that's a trend that's pretty well established now. So that in theory should be or could be deflationary, but then in Germany with the fiscal stimulus, you'll have some inflationary inputs as well. So overall, do you see inflation or deflation being the worry, or is it? And I know you guys have discussed this in the past, or are we just going to be in a period of inflation volatility?
Yeah, our view is that we have no real, short-term view, right? Our views are expressed by our different quantitative strategies that trade every single day. But I can tell you that broadly speaking, if you look at the inflation volatility from the late 20s to the early 80s, it was at least 3 times more volatile than it had been from the mid 80s all the way to 2020. And now from 2020 on, we're going back to that old paradigm. So what does that mean? It means that all of a sudden, nobody wanted to talk about inflation because nobody was worried about inflation for most of my career.
Yeah.
And what it means now is that you have to think about inflation and what you can do to protect yourself against inflation shocks, while also having a balanced portfolio to participate in case inflation doesn't happen and you have some growth periods in the portfolio, or if disinflation happens and you need to protect. So I think that the takeaway from everything that we are discussing is that it's really tough to tell which one of those macro factors is going to rule the day in any given year, but we're probably going to see all of them play out at some point. And inflation, something that was very, very a very difficult subject to try to even put on the table with investors, all of a sudden becomes an important topic on how to do proper portfolio construction.
Yeah, and the reality is that most people in the business today, even those of us that have been in, like Ovi myself, longer than we care to admit, it has been inflation came under control thanks to Paul Volcker in the 80s, and we've seen a secular decline in both inflation and more importantly, interest rates for 40 years, and that's changed.
Yeah. I think that, again, going back to the last 15, 20 years, the Fed only had to play a two-dimensional game, right? With inflation out of the way, the Fed had to play the game of it's growth on or growth off. And if it was growth on, then you increase rates a little bit, you reduce some of the monetary policies and reduce some liquidity, and you brought it under control. And then if there was a massive correction, you can print as much money as you could and add liquidity to the system to bring it back up. This is where we saw a lot of V recoveries.
Yep.
And throughout the last couple of decades, there's no it's two parts of you're balancing on a cylinder where you're just pressing on one side or the other and you're kind of finding equilibrium. Now, what anybody that has lived through inflation can tell you is that inflation, out of the dimensions of growth or negative growth shocks, when you add the inflation dimension, now you're balancing on a ball, right?
Yeah.
That is a much more difficult thing for the Fed and policymakers to deal with. And it is the number one thing that they need to focus on squashing so that they can get back to the two-dimensional game. Sadly, once the inflation is out of the bag, it is not driven by policy. A lot of times it's driven by animal spirits. And not a lot of times. It is driven by animal spirits as well as policy. And what you have to do now is you have to play this third angle while also convincing the population to stop asking for raises from their employers because they expect inflation to be going up next year. And that is a very, very difficult thing to do, as we're seeing, right? Inflation,
Yep.
the 2% target has not been hit. It's sticky at around 3%, depending on the numbers that you're looking at. And again, that's a moment of equilibrium at 3%, but it could spike up in a heartbeat. Or it could spike down as well if they do manage to have, I think what the Trump administration is trying to do is kill growth for a moment,
Yeah.
blame it on the Biden administration. And then with that growth, then convince people that you shouldn't be asking for raises and convince corporations to start firing people. And that's how you then create a self-fulfilling prophecy of, like, okay, we have inflation under control and we have disinflation. Now we're back to normal. But it's much, much more difficult than the game we were playing prior to 2020.
On the inflation front, I mean, one of the fears is tariffs themselves would be inflationary. But if you are a Chicago school economist, you'll say inflation is and always will be a monetary issue, and tariffs would be a one-time bump. In theory, be a one-time bump in prices. So there's the other factors aside. Central banks don't really have a role there because there's no expansion. I mean, tariffs by themselves do not expand the supply of money.
No, but you depends on how tariffs play out, right?
Yeah.
The reality is there's always been tariffs.
Yeah.
Right. It's just that the U.S. hasn't imposed tariffs on the world in the same way that the world has imposed tariffs on them. And, post World War II, that was a way of reshoring the decimation that Europe and other war-torn countries had exhibited. And it was a way to say, okay, we're gonna export everything you need, and you can charge a tariff in order to be able to get some money from us and reshore your economy. So tariffs on the other end have been high for a long time. They're very protectionist in Europe. They're very protectionist in LATAM, significantly less so in the U.S. Now, as the U.S. all of a sudden starts increasing tariffs, they're targeted, right? They're targeted.
Mm-hmm.
And if one hopes like, listen, I'm just going to increase these tariffs, please don't retaliate, and that's not a problem. But if you're escalating a war here, right? If you are actually escalating into, hey, I'm going to increase these tariffs, and then the other country says, well, I'm not going to sell you energy. And then, well, I'm not going to sell you, X product, and then it becomes and it escalates. The reality is that certain goods, and as we know, we have a basket of CPI, and there will be a lot of things that people need that will go up in price. That if not done well, that if the tariffs are not done well, then they can get into a lot of inflationary trouble for the kind of basics that people need. So it's just disruptive from a price perspective. Ultimately, it is money printing. It is credit, more than anything, credit expansion, right? You can print all the money. We tried to print our way into inflation for years. What we couldn't get is a credit expansion. And so what tends to happen is that in periods like these, credit goes down. Like the amount of credit in the system goes down. And so it's a balance between, this is what I mean by inflation volatility, is you're fighting all these, the moment of tariff wars, this is going up while credit's up, and then credit goes down because there's low growth, and then we have a massive disinflationary environment. And then the world goes round and round until we find a new equilibrium. And we will. Once the tariffs are set and Trump actually decides what he's going to do tariffs on, there'll be a new equilibrium, and then we'll see what the appetite for credit is, and then we'll see if there's going to be more or less inflation. But it is going to be volatile.
be interesting to see how these tariffs filter through to the markets, because on the news you see a lot of manufacturers, suppliers. They're saying they're going to have to absorb the cost because they can't pass it through. But eventually, as you said, the pressure is going to build, and then they're going to have to pass it through. And what then will be the impact on markets?
Yeah, I mean, it'll be sector to sector specific, right? Obviously, probably car manufacturers are going to have to push things through. I mean, most people who import most of their parts from China will have to take some of the hit and pass through some of that to the end investor. Right? But again, the goal here, like the reality is that these added frictions, and maybe every country reshores some of their manufacturing. That's fine, but it will make everything just slightly more expensive long term once we find. But again, inflation is not a continuous thing. Like it just, there will be a moment in time inflation that will happen based on these things, and then the credit expansion and monetary policy may or may not be able to manage that, right? But we gotta live through this period of chaos until we find the new equilibrium, and then hopefully things start to iron themselves out. But ultimately, I think this inflation discussion will be defined by whether the Trump administration actually wants a negative growth shock to get inflation, the persistent inflation down, and then they're going to want to blame it on the other administration, so they want to do it as fast as possible. And if they get that new equilibrium and everybody is okay, no, I'm not asking for raises anymore, then maybe that's a way to dampen down inflation going forward.
With the imposition of tariffs, and I would agree with you that the companies will pass most, but probably not all of that impact on. So does that present us with a permanent impairment in earnings?
It certainly provides that with an impairment in earnings now, right?
Yeah.
There will be like that. The initial shock will be that. Eventually, they're not going to, it's like anchoring and adjusting, right? They're not going to pass through everything to the investor right away. And the inputs the expense and inputs that are coming in today, as they reshore, and over the next 3 to 5 years, there's manufacturing that in Mexico, hopefully in Canada, once they agree to stuff that can bring the cost of manufacturing of their parts for their end product down. That'll be a way to increase their margin, right, from the initial shock, and then they'll pass that on to the investor. But sooner than you think. It'll be like anchoring, adjusting a little bit at a time, but it'll happen. And then you have a new equilibrium, and they'll find their way to be able to be profitable, right? That 10 to 15%. But part of it is going to be passing on to the investor. Part of it is going to be manufacturing that's expensive to do onshore now, will be less expensive in the future as in innovations and automation, and you start getting some strong arming to build more in the United States. You will find, the shock will be on the other side after the initial upward shock.
Yeah. I guess part of it too, as companies reshore manufacturing, I mean, the employment growth won't be what it would have been, in the 50s, 60s, 70s, 80s because of automation. And I've often, in my own mind, made the argument that labor has become, in manufacturing, labor has become a smaller and smaller part of your input, and the real cost is your cost of capital.
Yeah, and there's the other side of made in America, right? Which is not just the manufacturing side, but if you're a business owner and you're trying to create to make remotes that are made in America, and you're only hiring American manufacturing, a lot of that might be local automated manufacturing, but you as the company will get an extra bump from that local nationalism of people wanting to buy more American-made products. And that middle class on service and entrepreneurship might benefit from a reshoring.
Yeah. Well, that's certainly what we're seeing in Canada right now. The The amount of, when you look at the grocery stores, you talk to grocers, talk to consumers, the amount of buy Canadian has gone through the roof, which is good to see.
Yeah, I mean, it's certainly, I think a lot of countries have lost a lot of their identity over the last, when we become a global nation. We've literally almost adopted an American culture, like all those slang words that my kids in where I live in the Cayman Island now know. Everybody in Canada is using the same slang. Everybody in the U.S. is using the same slang, and Peru is using the same slang. So when you ask somebody from Ontario, tell me about your Ontario culture, a lot of what they will say is very, very much the social context of America, right?
Yeah.
This is the first time I've seen a lot of people talk about their values as Canadians. This tends to happen when you create a war. You become significantly more proud of the place that you live, and you want to defend it. So there'll be more and more of that. More proud to be whatever country you're in. Now, is that going to be better for the world? Probably not. But there is the nationalism will become a bigger theme over the next couple of decades, I think.
Yeah. Just swinging back towards the markets again. Couple things. We've talked about inflation, deflation, volatility there. Interest rates will be volatile as well because they are driven by inflation. But I think the other thing we're going to need to pay attention to, and professional investors get this. I mean, this is what they build their careers on. Retail investors often don't understand the causal relationship between interest rates and their effect on multiples when we're actually valuing a company. And so we could see periods, more volatility in that expansion and contraction of multiples.
Yeah, I don't think we've even started on the multiple front.
Yeah.
I think what's happening year to date has been more of a post-Trump euphoria. Like we're really not that different. The stock market, anyway, is not that different than when it was when Trump got elected.
No.
Right. So the multiples are still high. And like I said, I think when you look at the negative growth policies that are coming down the pike for short-term growth policies that are coming down the pike, that's going to be a reduction in multiples, and it hasn't happened yet.
Yeah.
So do you think this policy is going to trigger an increased allocations to international markets, ex-US, or even other asset classes as a result?
Yeah, we're seeing it right now, right? Like I think it's the largest differential year to date between the U.S. and global markets that we've seen in like 15 years.
Mm-hmm.
And again, look, it's not like Europe and the rest of the world is growing like gangbusters, right? This is where investors kind of get it wrong. We're like, well, this American exceptionalism, look how good we are at what we do, look at the amazing companies, and all those can be true. At the same time that the what you have to pay to own those companies are ridiculous multiples to their EBITDA. Right? And so the fact that Europe is doing better than the US has less to do with differentials in growth rates and more to do with multiple compression and equalization of those multiples. Right? There's this, it's just Europe and a lot of the emerging market countries have been trading at very low multiples for a decade, over a decade. That needs to equalize at some point, and we may be seeing a bit of that this year. And I think I definitely think that that there is a case to be made for global doing better than the U.S. in the medium term.
Do you think that's sort of the effect of people just blindly allocating to U.S. or S&P ETFs and that kind of investment, as opposed to picking companies or picking markets that are based on valuation?
So you're talking about the recursive, the pension plans and the superannuation funds and the life cycle funds just constantly putting a bid on equities.
Yeah.
Yeah, I don't buy into that. I don't buy into that theory. I think what's happening is what's been happening from a global perspective is that we have, the U.S. has exported all these goods, has basically financed the disinflation to the world for years. They have been having a trade deficit while the rest of the world is at a trade surplus. When they get that surplus in US dollars, they originally deployed it in treasuries, but over the last couple decades, they started deploying it in assets. And what can they buy in US dollars? They buy US equities. And that has been kind of the self-reinforcing process by which the US securities have gone up in multiples that don't make any sense. And throughout this, you've had a strong U.S. dollar. Generally speaking, when the globe starts underperforming, when commodities start going up, it has a lot to do with the currency. And part of the policy that I think Trump wants is to weaken the U.S. dollar. And what he also I think wants to do is go to every one of these major. It's going to be kind of like the Plaza Accord, where he's going to go to countries and say, "Listen to me, this dollar's too strong. I need you to start using your excess reserves and buy your own goddamn currency." And the moment that starts happening, then they start buying global stuff, and they start buying at the marginal dollar less U.S. stuff, and all of a sudden you're going to start seeing an equalization of multiples across U.S. versus global versus emerging markets. I mean, I think that's the policy that's going to go down. Yet we're seeing a little bit of it now, but ultimately these are cycles, and they're cycles driven by the last marginal dollar and who's buying. And if they can successfully convince global markets to stop buying hand over fist U.S. securities, then there might be a paradigm shift here where global outperforms U.S. That cycle generally lasts 5 to 7 years. It's lasted, as in like the differential when global outperforms U.S., 5 to 7 years. It's been 10 plus years now. We're a little bit long in the tooth there. My guess is we're going to have the opposite for a while.
And that answers the question I was just about to ask. Being more selective in diversification between asset classes and geographies, and making that connection with currencies is interesting. And my mind immediately goes to Japan, which has funded the carry trade for decades. Super low interest rates, weak currency was a great way to finance purchase.
And they're going to be forced, like the Plaza Accord did back in the late 80s, when they go down and actually do this, which I think is going to happen within 6 months. The Japanese yen started appreciating.
Yeah.
And other currencies, right?
Yeah.
They basically said, you do this, but also they said, you do this, like, I need you to weaken the US dollar, but to a certain extent, like they don't want it to just go crazy.
That's right.
Like, we still want to be the reserve currency.
Yeah.
And just don't want to be so strong where it's
Yeah.
And all of this is part of the kind of nationalist agenda, right? If you make it, if the currency gets weaker, it'll be better for the middle class and so on.
Yeah, but we saw a bit of that last year when there was the first worry on the carry trade came out. The first moves by the Bank of Japan to jump in interest rates up.
Yeah, it was in March of last year.
Which brings us around to not only the challenges we face, but the opportunity set that's out there right now. Because even before this latest series of market disruptions, we've seen a growing interest in alternative investments for portfolios, which covers a wide range, everything from private equity, private credit, hedge funds, long, short, real assets. We'll go through the whole list. And the biggest attraction, of course, for many advisors and investors has been their low correlation to traditional public market equities and bonds. And so the question is, should we be using the alts to cover all risks or specific risks at this point?
Well, it depends on the alts. So I think I bucket these in a few ways. Okay, so you mentioned a whole swath of alts. I think
Yeah.
today, because of what's happened in the last decade, when I talk to the vast majority of allocators, their alternative sleeve is dominated by private equity, private credit, private real estate.
Yeah.
Okay. Now I take offense as an alternative manager that those things are called alternatives. Okay.
Yeah, because they're long only positions. They're just not traded on a public market day to day. They
That's
don't
right.
mark the market on a daily basis, and that's the only difference.
Yeah, there's a bunch of white papers that show once you account for the 18-month lag on the private credit, private equity, what you get is the correlation is like 0.9 to the S&P for private equity, for example, right?
Yeah.
And so they are alternative structures, but I call those alternatives non-diversifying alternatives. Okay, so they do not add diversification. If the world has a terrible 3-year period, they will also have a 3-year period just by a lag. Right, so they're not diversifying. They are simply different ways to invest, and you want to talk about the illiquidity premium and whether there's some excess returns there. There have been. The question is, at this point, given how much demand there have been for them, whether the multiples warrant continuing to own them down the line. So then there's that first category of what I call non-diversifying alternatives, that volatility launder. Right. Now we get into the real alternatives. This is a framework that came out of Makita that talked about first responders, second responders, and third responders. Okay, the first responders are the ones that if God forbid, there's a bomb that drops in the middle of New York City and things go haywire this minute, those first responders are certain alternative strategies that will be there to protect you and actually completely offset losses from your equity portfolio. So these would be long volatility strategies, really short-term managed futures traders, put option strategies, and so on, right? So this is like tail protection strategies. And so that is a category that I think a lot of people are looking at these days, but because of the misunderstanding of what they are, a lot of people are disenfranchised because it didn't protect them in 2022. 2022 was not a massive couple of week shock. It wasn't a COVID, it was a prolonged bear market, right? And so for that second type of bear market, you want the second responders. And these are directional long short managers such as managed futures trend, systematic macro, out of all the categories that are out there, the ones that can handle changes in macro environments that tend to last weeks to months and make a lot of money during those periods are managed futures trend and systematic macro. And I think those are crucial allocations for anybody's portfolio. And then you have the rest of the alternative space, which is like what I call the third responders, which are mainly indifferent to market environment. They're just trying to have zero correlation to the S&P most of the time. They're making consistent alpha returns that are just going to be there day in and day out. Market goes haywire, they may lose a point or make a point, and over the year, the goal is to make money. But it's not there to really offset any losses from your portfolio. But if you have a 10-year bear market and you have these third responders that are just chugging along, making you 5-6% a year for 10 years, and from 2000 to 2010, the S&P did zero, you can see why it can be a third responder making you some money during like a decade's worth of bear markets, right? So this is the framework that I think people think they should look at.
I think Covey, he is talking about on third responders are SDA plus portfolio.
Yeah, sounds very much like it.
Yeah. Yeah. How dynamic do we need to be? Do you think that we need to be in that allocation? Each one of those buckets has a different role. They react differently under varying circumstances. Do we need to be dynamic, or do we need to just take a set and forget?
I'm very much a proponent of set it and forget it, right? Yep. But you want the things that you set to be working for you. Like none of the alternatives that I mentioned are sitting on their hands and just buying and holding. No. They're making trades every single day and trying to do what's best for the investor. But you don't have to, right? You don't have to. For you as the allocator, what you're doing is making decisions as to what your client's behavioral flaws are, what their retirement needs are, and then creating a portfolio that matches the optimal portfolio with their behaviorally optimal portfolio. And this is the biggest challenge with diversifiers, is making sure that your client can handle owning things that are different than what they're used to, right? So that is it's a discussion one client at a time. And the proportion that you give to that alternative sleeve, I have clients that are 100% alternatives. And I have clients that don't have any alternatives. They'll stack them on top, as we can discuss a little bit later.
Yeah.
They want to have full exposure to the market because they believe long term they're going to make better decisions that way.
Yeah.
So it's the way I do it for my portfolio is I equal risk allocate across equities, bonds, gold, and alternatives.
Yeah.
And those weightings for most people would be unpalatable, but for me, it's just right.
Do you do it on a risk parity basis?
Basically, yeah. So risk parity just basically means if I have equities that have a volatility profile of 20 and they move independently of what bonds move, but bonds have a volatility of 5, if I do a 50-50 portfolio, I may feel like I have an equal risk portfolio, but the reality is that I like to use a motor analogy, right? If a motor has a set of pistons and they move up and down in different times as you move along the road, people think when a 50-50 bond portfolio, they have 2 pistons that are the same width. But the reality is that what they have is a piston that is this big for equities and this small for bonds. Bonds, yes, went up in 2008 when equities went down, but the impact of that massive piston going down affected the motor and your ability to get to your destination. So risk equalization means I want to give more assets to the things that have lower volatility and less assets to the things that have higher volatility so that I can create a motor that's balanced, pistons that have the same width. And then what I want to do is add as many pistons that move independently as possible that have the same impact to the motor. And the more you do that, the smoother you ride.
Yeah. Yeah. Yeah.
By the way, that for me means like only owning 25% of equities, which is unfathomable for most people, right?
You're way too young to have that small of an exposure.
Oh, don't worry. I use enough
equities.
leverage so that it doesn't matter.
And using leverage takes us to not quite the final thing that I want to touch on. That Resolve has been very innovative for a number of years. I should let our audience know that Rod and I have crossed paths for a number of years. We were both at Scotia decades ago, at Macquarie together, and I've known him since he and his partners, Mike and the rest, set out to create Resolve. But you've recently, I say recently, within the last couple of years, brought out what in Canada is a new ETF product. You've had it in the States for 2 years now. Yeah. That combines both your own alt strategies with a market beta products. And can you elaborate on the theory and the application of this strategy, which I'll let you name because it's up there behind you?
Sure. It's so the concept is called return stacking. And it's just a rebrand of a very old idea that institutions have been applying for decades. 2021, I'm faced with trying to convince people to add diversification in what could only be described as a decade of a bear market in diversification, right? I'm saying to people, sell those things that have given you 16% annualized rate of return and add this thing that I know has underperformed the S&P 75% of calendar years. I know. But when things hit the fan, they will protect you. And because of the rebalancing premium, you're actually going to end up on top. Nobody cares about that, right? What they care about is how they did this year. And it was at a time where rates were at 0, valuations were at 38. And people knew that they needed to diversify, but they just couldn't bring themselves to it. And the way that institutions have dealt with that problem is they don't have, like the good ones anyway, don't necessarily sell their equities and bonds to add these first, second, and third responders. They don't do that. What they generally do is they'll keep their 60-40, And then they will stack those diversifying returns on top by borrowing against their equity and bond portfolio, right? So they will keep their allocation, they will borrow money, and then they'll stack returns on top. So for example, the Delta Pension Plan is somebody that we interviewed in our podcast a while ago. They went from, in 2011, from being 36% funded to 100% funded by doing a 60-40 and an extra 40% of alternatives on top. And it was a way to add extra returns that, because they're not correlated to the 60-40, don't add extra risk necessarily, and in fact help reduce the peak to trough losses. Now, the problem was that in the retail space, up until a recent rule change, it wasn't possible to do that.
Yeah.
In 2 or 3 years ago, the regulators came out with guidelines as to how you can do portable alpha, what I called for retail return stacking. And it went viral, that paper that we wrote. And we decided to launch an ETF company in February 2023. We've launched 6 ETFs in the US, 1 in Canada, a mutual fund in the US, and it's around 1.4 billion Canadian 2 years later. So this is, what's interesting here is that it was the same story, but packaged in a way that was behaviorally palatable.
Yeah.
Right. And the big unlock there is to keep it simple. Now, the second ETF we launched was, okay, I get it. You want your S&P 500. Totally get it. Here's an ETF that'll give you the S&P 500 return. Every dollar you give us, you're going to get $1 of the S&P. But you're also going to get $1 of managed futures trend, which is a second responder I was telling you about, that has the ability to really offset losses for that equity portfolio. And yeah, the other times it only does 1%, 2%, 3%. But when you're stacking 1%, 2%, 3% on top, S&P does 20. You stack 1%, that's 21.
Yeah.
That's incredible for most people, beating the market even by 1 or 2% over a long period of time. And so it's there even when it's low returning. When in a period like 2022, when the SocGen Trend Index, which follows the space, is up over 20%, that's great as a stack. You get a 20% stack that time where the S&P is down 30. And then there will be periods where, 2 to 3 years out of 10, where the trend is down 3, 4, 5%. It tends to be when the S&P is up 20%. So that S&P is up 20, your 1+1 prepackaged solution is only up 15. Clients aren't really going to complain about that, right? Yeah. And so the big unlock here is going back to advisors and saying, do you remember that diversification promise that you've been told and you need to have, but you can't hold on because you'll be fired? I think we found a way for you to give your clients what they want while sneaking in what they need. And they won't complain as much because the line item risk gets really condensed, right? And they get to get the returns that their neighbors and friends got, and they get to stack some extra over time.
Yeah.
And that was a big unlock. It was an old story told in a different way with new packaging.
Yeah. The because the traditional way of adding the alts in has always been, I'll sell some of my equities, some of my bonds, allocate that to the alts. But as you rightly say, in those years the alts aren't performing, people will rightfully question why do I hold this in my portfolio? And the answer is because one day you're going to need it, just like you need house insurance.
Exactly.
Whereas by stacking it on top, you're still, for your dollar invested, you're still getting $1 exposure to those traditional long-only markets.
And this is how institutions cheat.
Yeah.
Right. They're cheating, but they're winning. This is a direct quote from the CIO of Delta Airlines. It's like, I'm cheating, but I'm winning. Right. You think about, it's as old as time, this concept of allocators and advisors wanting to beat their markets, right? I'm going to bring you and I'm going to do better than the 60-40. And the way they've tried to do that is by picking better stocks or picking better bonds than just a buy and hold. And as we know, that's a toughest game in the most liquid markets and the most competitive markets in the world. When you look at the SPIVA reports, you're looking at top quartile managers over the last 15 years, outperforming by 1.5, something like that. Yeah. And that assumes that those quartile managers are going to outperform over the next 25 years, which we know isn't the case, right?
No.
So just stock picking is really tough. And that's why we've kind of gravitated toward indexing. But what we do know, if you look at any category in the hedge fund space, that over time, the returns of those categories, market neutral, long short, systematic macro, managed futures, they're adding 300 to 400 basis points, that's 3 to 4% a year above cash.
Yeah.
That's and consistently, right? And so now you can say, okay, I want to outperform 60-40. How do I do that? Do I want to do it by stock picking and bond picking? Or do I just want to stack more consistent diversifiers on top of what I do, which is what these institutions have cheated in the last 4 decades. And that's what we finally can offer in the Canadian landscape and in the US as well, which is it's the growth is evident that the market needed such a solution.
Yeah, and of course for advisors or private clients, to do it themselves entails making sure that opening a margin account and taking on that leverage risk yourself.
Well, you can't do it unless you're an institution, because for this to work, you need to be able to get institutional borrow pricing. Like you need to get institutional pricing.
Yeah.
So individual investors, I mean, they can do it now by buying ETFs like these that have an institutional quality. You know what I mean? But to do it themselves, like this, retail investors have had access to margin their whole lives.
I know,
but
it's
they're
expensive.
getting charged 14 to 20% to get exposure to the same risk.
Yeah.
Right? Because that's the other thing. I think what's happened in retail up until now is that there has been this ability to borrow at exorbitant rates. And what they've been taught to do is that what you do is you lever up the same risk. And that's just, every major disaster in finance can be attributed to concentrated leverage.
Yes.
And these two double bull S&P ETFs, triple bull S&P ETFs, I mean, traders, if you use them well, they're great instruments, but a lot of retail people have been blown up by that. So it's crucial as we get into this next phase of return stacking and portable alpha that people understand what the difference is between that leverage and defensive leverage, which is what we are trying to do. Right. So we actually came up with a fun little acronym. One of our sales members came up with the concept of LICE. That when you're dealing with leverage, you don't want LICE, and LICE stands for leverage that is illiquid, concentrated, and excessive. Right?
Yeah.
Illiquid, concentrated, and excessive. That's a double bull, double bear. What you want is leverage that is diversified, defensive when you need it to be defensive, and as liquid as it gets. Right? When you put those three things together, and you get what institution won the Nobel Prize with William Sharpe in the 50s and 60s. So that is the big innovation here.
Yeah, that's great. Well, I think that's bringing us up to our time. I'd really like to thank you for joining us, Rod. It's been a fascinating conversation. We've gone from soup to nuts, and I think we've all learned a little bit more. And we'd really like to wish you and Resolve all the luck as you go forward with your new suite of products. Any comments, Sam or Ovi, as we wrap up?
Well, thank you, Rod. I found that very interesting, and good luck in your return stack ETF.
Yeah.
Thank you, Sam. You don't have anything for me, Sam?
I don't think so. That was great.
Okay.
Well, thanks, Russ. Appreciate it.
No problem. And one question before we go. What's the web address for Resolve?
So there's two addresses to look into. For the Canadian return stacked ETFs is returnstackedetfs.ca. And for Resolve Asset Management, we do more bespoke, hedge fund. We do return stacking for separately managed accounts, a bunch of stuff. That is investresolve.com. Okay? So those are the two kind of major places that you can look into. If you want to look at the US ETFs, it's returnstackedetfs.com. And if you want content and webinars and blog posts on the whole concept of return stacking, we got hundreds of them in returnstacked.com. Returnstacked.ca, ETFs.ca, returnstackedetfs.com, and returnstacked.com.
Perfect. Thanks, Rod. Thanks, Ovi.
All right.
Thanks, Sam.
Thanks, Russ. Thanks,
Thank
team.
you.